Good afternoon. I'm Nicole Truog, Associate Director of the UW-Madison Center for Financial Security. Welcome to today's webinar on financial inclusion. Our presenter today is Drew Anderson, PhD candidate in the Department of Economics at UW-Madison. And our discussants are Susan Burhouse, Senior Consumer Researcher, FDIC Division of Depositor and Consumer Protection, and Michael Morris, Executive Director of the National Disability Institute. A couple of quick housekeeping items before we start. If you have any technical difficulties, please call 1-800-442-4614. And to submit questions for the Q&A portion of the webinar, locate the dark gray bar near the top of Media Site, click on the Ask a Question icon, and a window will open. Please type your name, email address, and your question, and then hit send. With that, I'd like to turn it over to Drew.
Thanks, Nicole, and thank you all for tuning in. When you think about family financial security, it might not always pop into your mind that the federal government has a direct interest in family financial services choices, like whether or not a family opens a bank account. The reason for this interest is that the government has to transfer cash payments to certain families, and that's safer and more inexpensive when the family opens a bank account. Conversely, families also care about government payment choices because it affects their bottom line. The way the government chooses to deliver payments has an impact on family financial security as well. And the specific example we're going to talk about in this realm is the move to electronic Social Security payments and its impact on the unbanked. This research paper is co-authored by myself, Alexi Strand at Social Security Administration, and Michael Collins here at the UW-CFS. And I should mention that the opinions and conclusions I express today are solely those of us authors. The two populations I already mentioned are the unbanked and Social Security payment recipients. So I'm going to stop to define them real quickly. The unbanked do not use checking or savings accounts. More specifically, in our study, we use a survey question fielded in January 2009 to the head of the household about whether anyone in the household currently uses a checking or savings account at a bank. If they answered no, then we consider everybody in that household to be unbanked. Social Security delivers payments to the population through three major programs. OASI goes to retirees and their spouses. DI goes to people with a significant work history who have suffered a work-limiting impairment. That's a long-term health impairment. And SSI goes to people who may not have a substantial or recent work history, but nonetheless are unable to work because of a health impairment, and they also must pass a means test. Now, to give you a sense of the size of these two populations, if each one of these figures were 1% of the United States population, 7 of them would have answered that they were unbanked in our sample. 18 of them, almost a fifth, would receive in that same month that they answered they were unbanked or not, a Social Security payment. Now, instead of dividing by the administrative categories that I showed you on the last slide, we're going to do a little bit differently on this slide and cut these Social Security payment recipients into disability and non-disability payees. The people who receive a disability payment either receive DI or SSI for a disability, and all the rest of payments go into the non-disability, which includes mostly retirees. Now, it's pretty clear from this statistic that most payments from the Social Security Administration are for retirement. But if you zoom in to the 1% overlap between unbanked and Social Security benefit recipients, that changes drastically so that actually in that 1%, where we're going to focus the rest of this talk today, over half of the payments are for disability. So this 1%, they're not the usual 1%ers you hear about at the top of the income distribution. They're very different from that. And I'm going to tell you why we care about that particular slice of the population. First of all, they're unbanked, which is a sign demographically of economic vulnerability. The unbanked are more likely to be young, female-headed households, poor, and belonging to racial and ethnic minorities. Being unbanked per se may impede transactions, savings, credit, day-to-day financial life, and even employment. Now, when you add disability, this population becomes especially interesting because the same disability that limits the ability to work and might qualify someone for government payments could also limit the utility of a bank account, either through just having less income to deposit or directly through mental and physical barriers to use of a bank account. We're wondering if this could be helped by representative payees, which are friends or family or other institutions that can receive Social Security payments on behalf of the qualifying payee. Methodologically, one reason we're concerned about unbanked payment recipients is because both of these things are tough to measure in surveys. Both being unbanked and being a recipient of government support are often misreported, and you'll see that going forward as a theme of my talk today. But above all, this 1% of the population is interesting because they will soon be forced to make a lifestyle change because of the mandated change to electronic payments. There's a new U.S. Treasury policy which is actually the result of an old rule passed in 1996, but is now coming to fruition and being phased in, that all non-tax payments must be made electronically. That is, a direct deposit to a bank account or other electronic account, not by a paper check in the mail. And that has to happen by March 2013. The government projects that it will save about $100 million a year just from this policy, and there are other non-pecuniary benefits like going green. Where our research comes in is we want to predict the other side of the cost-benefit equation, the costs that are borne possibly by payees. We focus on Social Security payees because they represent 80% of non-tax payments from the Treasury. Many people, when we started this study, or when we look in January 2009, are actually receiving a paper check. And for those who have a bank account and receive a paper check, they'll easily be able to switch that payment into an already existing account that can receive electronic payments. For the unbanked who are currently receiving a paper check, they'll have to either make a move all the way to mainstream banking or to some sort of intermediate product, such as the Direct Express Debit MasterCard. This is a simple financial instrument which is developed exclusively for federal payment recipients. It can receive federal payments, make a few transactions in stores, and it can be cashed at ATMs. Ever since this policy has begun to be phased in, there's been a big marketing campaign about the benefits of going direct versus receiving paper checks. This is a snapshot of godirect.gov, complete with a suspenseful countdown to when everybody must go direct. And the Treasurer of the United States is here sharing a video of why it's important to go direct. So this is a big push to move these families away from paper checks into electronic payments. Now, to answer the questions we posed about the impacts of this policy, we have a few research goals. First, we want to characterize bank use among payment recipients. That is Social Security payment recipients. We're going to add to a long line of estimates of this figure. Ours is going to be updated and use slightly different methods than have been seen in prior literature. Secondly, we want to know how those payments are delivered to Social Security payees. We're going to look at the method of payment chosen, especially by the unbanked households, whether that be electronic or paper, and whether it goes to the payee themselves or a representative. And a sub-question that's popped up that we'll talk a lot about is whether or not survey reports of being unbanked accurately capture access to electronic payments. We're going to use this information and some more information about reported banking preferences to identify groups that are likely to be adversely impacted by mandated electronic payments. Now, these are pretty simple tasks given the right data. So data is going to be key and measurement is going to be key for this research. What we need is a large sample data set because these are such small slices of the population, and we need that data set to include measures of bank account use and of Social Security payment receipt, and we'd love it if it also included demographics and as much information as possible about the financial services available to these families. Our strategy on that data front is to link two data sets. The FDIC fielded its National Survey of Unbanked and Underbanked Households to the January 2009 Current Population Survey sample. This is a large nationally representative sample, and this survey was the first of its kind in being completely focused on financial inclusion. It asked about whether families were unbanked and their reasons for being unbanked in a large sample. And of course, because it's the CPS, we have some good demographics. Myself and Alexi and Michael had the unique opportunity to link March 2009 CPS data to administrative records from the Social Security Administration. And this was done for us by the Census Bureau. And from there, I won't get into details, but because of the way the CPS works, we were able to merge the March households to the January households at a rate of about 70%. So we lose some households in our statistical matching process, but what we end up with is a pretty big sample of households, which is based on the CPS. And what we can do is roll back to study actual payments that were delivered in January 2009 versus actual survey responses given in the same month. So to address the first research goal, we want to know who is unbanked among Social Security Administration payment recipients. On this chart, our estimates appear on the left-hand side, and these are all among our matched sample, and then other estimates from various studies appear on the right-hand side. The first comparison I want to draw is along the top line. Even though our study is based on the FDIC 2009 survey, we have a slightly lower proportion unbanked. We think this is because our matching process loses a few households that are moving around and tough to match, or they're maybe growing and changing, and those households happen to be more likely to be unbanked. So that's just a caveat going forward, that we slightly underestimate the counts of people unbanked versus the FDIC study. Now next, looking at the U.S. population, which is 6.6% unbanked, versus the Social Security population, who is 6.3% unbanked, there's actually no statistical difference there. Being a recipient of a Social Security payment makes you no more likely to be reporting that you're unbanked. But this hides a difference within Social Security, that OASDI recipients are much less likely to be unbanked. And remember, these are heavily retirees, while SSI recipients are much more likely to be unbanked. And these are people with disabilities, the aged, or maybe children with disabilities. Comparing our study to some older studies with different methodologies, they find the same qualitative conclusion, that SSI is an indicator much more likely of being unbanked. But on the whole, their numbers are much, much higher. So why are our estimates lower? First of all, I mentioned the caveat that our CPS matching process slightly loses some changing households. Another difference is the FDIC sample is large and representative versus some of the samples that have previously been used, which were small directed surveys. Secondly, we have administrative identification of recipients. I mentioned before that it's tough sometimes to believe survey evidence about which payments are coming into a household, and we, instead of using surveys to identify payment recipients, use administrative records of actual money transactions between the Treasury and households. Last of all, we look in 2009, and there's been a slow trend downwards over the 2000s, over that decade of unbanked, and some of the other studies we were comparing to were slightly earlier. The main reasons for the differences, though, are the methodologies. And again, the qualitative relationship holds. The SSI folks are much more likely to be unbanked in our studies and the older studies. Now we want to move into this overlap population that reports being unbanked and receives a Social Security payment. And this was a surprising result for us. The first thing we did, we wanted to know how many of them actually received paper checks, because the unbanked who receive Social Security paper checks are the ones going to have to make the largest transition. And surprisingly, over 2/3 of the unbanked Social Security payees don't receive paper checks, but in fact receive some sort of electronic deposit. We expected, in other words, the blue bar on the top of this chart to be very small while the red was large. On the bottom bar, the fact that there's any red just says that some people with bank accounts just like to receive paper checks, and they'll still be able to easily transition away from that. So why is this? This is another result that deserves some explanation. Why the, quote, unbanked, the people who self-report being unbanked, have electronic access. One reason, which we can measure in our study, is that they might have designated representative payees outside the household. So someone else outside the household does have a bank account or an electronic account to receive payments. That means that the report that no one in the household has a bank account could still be accurate, and that accounts for a few of the observations, but not all. Another thing that could be going on is that people enroll in Direct Express, and the survey respondents don't consider that a bank account, but nonetheless it's able to receive electronic payments. that accounts for another tiny fraction of this clash between administrative and survey data. Similarly, there might be other non-bank electronic accounts which we don't know much about. And another possibility could be that the survey was administered in a different point of the month within January 2009 than was the payment. So that in these kind of tumultuous households, things could be changing quickly within a month, and we might just not be able to capture everything at the same time. None of these are really satisfactory to us to explain this big discrepancy, this surprising over two-thirds result that over two-thirds of people are receiving electronic payments when they say they're unbanked. So I really look forward to your feedback on why this might be. But what we're left with for the moment is that people are just misreporting. They actually have a bank account, but at survey time, they're not quite accurately representing the fact that they do. I'm going to skip a couple of these slides just for time's sake and talk about misreporting. So it could be that people who respond to surveys have different definition than the survey writers of what a bank is, what a household is. These are kind of unlikely, but they're possible. It could be that SSA payments just aren't seen as a part of regular finances, and that's where the disconnect happens between survey and administrative data. It could also be that people answering survey questions on behalf of their households have a lack of knowledge of other members' finances. Maybe the other members are in different generations, or other members with a disability, and these are key things to focus on as we go forward with studying this population. We want to know who is most likely to be misreporting. I'm also going to skip this, it takes too long to explain, and just give you the upshot of that is that misreporting is most likely among households who receive a disability payment. So what we're doing here is pointing out another economic variable that is prone to survey error. It's well known that survey respondents are erroneous in reporting their earnings, their assets, transfer income, health status, etc. And we're adding transaction accounts to that list. And what we know so far in our research is that that misreporting is most likely among households receiving a disability payment. Our next step is to more specifically add up all the rough measures we have of sources of misreporting to get a better handle on this, and we'll in process on that. So shifting away from the administrative data, we know that even if banking, whether or not you have a bank account, is measured perfectly, it's not a perfect indicator of financial inclusion. People who are unbanked at any given time are commonly moving in and out of mainstream banking for all sorts of different reasons. So we took questions from the FDIC survey about reasons for being unbanked and aggregated them into 3 categories based on the situation that will be faced by Social Security payment recipients after this switch to electronic payments. So let me explain here. This orange group have expressed preferences against banking, which we don't think could possibly be improved by the Treasury's offering of the Direct Express card or other alternatives. People are just averse to mainstream banking. They don't trust banks. It's kind of a small category. It's 11% of the people who said they were unbanked and currently received a Social Security payment. A big category in the middle is the yellow one. This includes most commonly people who say they just don't have enough money to make banking cost effective, and a variety of other reasons. We don't really know how offering payments on a different medium could change the amount of money people have, so we're just going to lump that into ambiguous. And thirdly, and perhaps most importantly, there are a chunk of people who may even be helped by this process because they'll have a new set of choices that includes the Direct Express card. These are people who cited their main reason for being unbanked was that minimum balance requirements were too stringent, or that they have credit problems that disqualify them for a bank account but wouldn't disqualify them for a card like the Direct Express. So this is somewhat encouraging that a slice of the population may in fact be helped by this policy. So to sum up, in surveys we found that fewer recipients are unbanked than in previous estimates. Just 6.3% of Social Security payment recipients say they are unbanked. We were surprised by the fact that this clashed with administrative data. 69.1% of that chunk said they were unbanked, but in fact received electronic payments. So what this did is immediately shrunk the size of the population we were worried about having to make a transition after the Treasury phased in all electronic payments. The policy impact, therefore, is smaller than expected. Fewer need to shift, and the reasons analysis we did in the last slide showed us that some of them may even benefit. But the theme running through all of this is that disability payment recipients face the largest transition. They're heavily concentrated among the people who say they are unbanked and actually receive paper checks. And so in this policy change, households with disabilities are a key focus for smoothing over the move from paper checks to electronic payments of Social Security. Now, our study has a few implications for future research, which I'll leave you with. One, that surveys somehow need to improve at capturing this particular economic variable of financial inclusion in the banking system. One way to do it would be to ask more and more specific questions, which of course has a cost on people's time, but could possibly draw out better information. And the FDIC fielded their survey again with improved and more specific questions. So surveys are moving in that direction. No matter what, we think it's valuable, whenever possible, to validate surveys with administrative data. It gives a different view, sometimes a more trustworthy view, sometimes not. But in our survey, or our study, excuse me, it certainly changed what we thought and the conclusions we drew. So I want to conclude by saying that, again, that the impacts of government income support policy depend on financial inclusion and capability. Cash delivery methods matter, especially for a very few households with low income, low assets, and high likelihood of having disabilities. Thanks for listening. I look forward to your questions. Thanks, Nicole and CFS, for inviting me to do this webinar.
Great. Thanks, Drew. And with that, we're going to turn things over to Susan Burhouse. But just quickly, a reminder to participants, please go ahead and start submitting your questions for the Q&A portion of today's webinar. Susan?
Hi. Thank you, Nicole. I'm glad to have the opportunity to participate in this webinar this afternoon. And I'm actually really excited about Drew's paper. We were really happy to see that Drew and his co-authors have put the FDIC household survey data to such good use in their research. Drew already gave you a little bit of information about the FDIC data and how he used it, but I'm going to talk more broadly about the main findings and policy implications from the 2011 survey of unbanked and underbanked households. This research report was co-authored by myself and Jasmine Osaki, who's also of the FDIC's Division of Depositor and Consumer Protection, and supported by an interdivisional survey research team at the FDIC. Moving on to slide 2, I'll start with a little bit of background. The FDIC sponsors this research in part because there's a statutory mandate that requires us to provide estimates of the unbanked population in the U.S. and to identify issues that could prevent households from establishing mainstream bank accounts. The FDIC also has long held a larger commitment to ensuring that all Americans have access to safe, secure, and affordable banking services, and this survey is just one part of the FDIC's many economic inclusion initiatives. The household survey is conducted by the U.S. Census Bureau as a supplement to the current population survey, and the current survey was administered in June 2011 to nearly 45,000 respondents, or 84% of all CPS respondents that month. And this is the second time that we've conducted the survey. The first one was conducted in 2009, and those were the data that Drew was using. And we plan to continue conducting this survey every 2 years. Moving on to the next slide, we'll get to the first set of main findings regarding household banking status. And the main takeaway for us here is that there really continue to be a lot of opportunities to increase banking engagement among U.S. households, over 28% of whom are unbanked or underbanked. And specifically, we found that an estimated 8.2% of households, or nearly 10 million households, don't have a checking or savings account. Relative to 2009, the unbanked rate was up by 0.6 percentage points, which translates to an additional 821,000 households that are unbanked. Another 20.1% of U.S. households are underbanked. And this means that they have a bank account, but they also used alternative financial services, or AFS, in the past year. Specifically, there were 7 types of AFS that we asked about in the survey. They were non-bank money orders, check cashing, remittances, payday loans, pawn shops, rent-to-own agreements, and non-bank and refund anticipation loans. And underbanked households had to use at least one of those types of AFS products in the last year. In all, there are about 24 million underbanked households in the U.S. that are home to about 51 million adults. I should point out that we made some small changes to the underbanked definition between 2009 and 2011, so the underbanked estimates actually aren't directly comparable across years, but we did look at a variety of other measures and found evidence that AFS use increased both among unbanked and banked households. On the other end of our banking status spectrum, there are about 70% of U.S. households that we are calling fully banked, and this means that they have a bank account and they did not use AFS in the past year. And I should make clear that while our framework defines these fully banked households as the most financially engaged, this isn't necessarily the end of the road. There are still opportunities to improve the quality and sustainability of fully banked households' relationships in many cases. And moving on to the next slide, you can see how much the estimates differ by demographic groups. And this is consistent with the 2009 survey results. In 2011, we found that both unbanked and underbanked rates were particularly high among non-Asian minorities, among lower income, less educated, younger households, unmarried female family households, unemployed households. Many of these groups had unbanked rates around 20% and underbanked rates close to or even exceeding 30%, meaning that less than half of the households in these groups are fully banked. Now, it is worth considering that even though low compared to other groups, the proportion of fully banked households in these groups is still sizable, and this does provide evidence that it's possible to bank low-income or unemployed households, for instance. It can and does happen. On the next slide, this highlights one of the strengths of the survey, the fact that we get not only national-level data, but also data at the regional, state, and MSA levels, so we can look at geographic comparisons. Looking first at the unbanked results by region, we find that, again consistent with 2009, the South has the highest concentration of unbanked households. The South is home to about 37% of all U.S. households, but 46% of all unbanked households live there. The unbanked rates vary widely by state, from a low of 1.9% in New Hampshire to over 15% in Mississippi. Underbanked rates also vary a lot by region and state. The South, again, has the highest underbanked rate at 23%, and the underbanked rates by state varies from 12.5% in New Hampshire to over 31% in Nevada. Moving on to the next slide, this chart digs deeper into the banking histories of unbanked households. Of the 8.2% of households that are unbanked, slightly more than half have never been banked. And relative to the overall population, it's really just about 4% of all households in the U.S. that have never had a bank account. So that proportion seems relatively small, but among certain demographic groups, the rates are really quite high. For example, among all Hispanic households in the U.S., about 15% have never had a bank account. On the other hand, we have slightly less than half of unbanked households, about 45%, who have owned an account in the past. Of these previously banked households, about 1 in 5 have become unbanked just within the last year. And these results really raise some concerns for us from an economic inclusion policy perspective about our ability to retain households in the financial mainstream and to establish long-term banking relationships. Moving on to the next slide, you'll see the reasons why unbanked households don't have bank accounts. We find that this is one of the areas that gets the most interest and attention, but it's also one of the most challenging for us to collect and to analyze. We actually asked these questions pretty differently in 2011 than we did in 2009, but the results came out basically the same. Overwhelmingly, the most common reason for being unbanked is not having enough money. And this is true both for households that have had an account in the past and those that have never been banked. The second most common reason is that the households simply say they don't need or want an account. Notably here, though, we can see that previously banked households were less likely to say that they didn't need or want an account, perhaps implying that once households have had a bank account, they do come to value them. Moving on to the next slide, we'll see that the survey also questioned unbanked households about whether they thought they would open an account in the future. And at first glance, the results really don't appear overwhelmingly optimistic. The majority of unbanked households, about 60%, report being not too likely or not likely at all to open an account. There are some bright spots, though. Almost half of previously banked households were somewhat or very likely to open an account in the future. And among these previously banked households, about two-thirds that became unbanked the most recently, just within the last year, felt that they were likely to open an account again. There were also some differences we noticed by demographic groups. Households comprised of unmarried female families and younger households stood out as among the most likely to want to open an account going forward. Why do these households want to have bank accounts? The next slide shows the answers here. About 30% cited transactional needs, or the needs to write checks and pay bills, and savings needs, the needs to secure the household's money and the desire to save money for the future, were each cited by about 25% of households. And we think this data is pretty useful because you can actually match households that have intentions of opening an account with their reasons for wanting an account, and this can really aid in the development of appropriate and targeted products and outreach strategies. Moving on, the next slide gets into another of our main findings, and this is about the types of bank accounts held by U.S. households. These questions were new for the 2011 survey. We found that just over two-thirds of U.S. households have both a savings and a checking account, and most households, close to 90%, have a checking account, but only 69% have a savings account. So with 3 in 10 households in the U.S. lacking a savings account, there does appear to be clear opportunities to expand ownership there. And notably, it's true among both underbanked and fully banked households. Almost one-third of underbanked and about 1 in 5 fully banked households lack a savings account. On the following slide, you can see how quickly account ownership rises with income. Only about two-thirds of households in the lowest income group earning under $15,000 a year have a checking account, compared to almost all households with at least $75,000 in annual income. And the disparities in savings account ownership are even more dramatic. Only about 37% of households in the lowest income group have a savings account, compared to close to 90% of the households in the highest group. And we also looked at some other demographic breakdowns, and we saw that Black and Hispanic households, as well as unmarried female family households, were among the least likely to have savings accounts. Only a little bit more than half of the households in those groups had savings accounts. The next slide introduces the last set of key findings regarding the household's use of AFS. And this chart shows the types of AFS used. You can see that transaction AFS, which were money orders, check cashing, and remittances, are much more commonly used than credit AFS. Almost 1 in 4 households in the U.S. had used a transaction AFS in the last year, compared to just about 6% that had used AFS credit. Looking at the specific products, non-bank money orders were the most frequently used by about 1 in 5 households in the last year, followed by check cashing, which was used by about 8% of households. Moving to the next slide, we see the time frames in which households used AFS. And 43% of all households had ever used at least one of the types of AFS included in our survey, and about 1/4 of households had used AFS in the last year. And more than 1 in 10 households had used AFS in the last 30 days, and that included about 40% of unbanked and underbanked households. Now remember that even some of the households that we're defining as fully banked have in fact used AFS. About 1 in 4 fully banked households used AFS more than a year ago. Now the next slide focuses on the use of prepaid debit cards. Prepaid cards are actually not a part of our underbanked definition, and in fact our survey doesn't distinguish between cards provided by banks and those provided by non-banks, but it's still interesting to look at consumers' use of these prepaid products. We found that about 1 in 10 households in 2011 reported having ever used a prepaid card, which was pretty stable from 2009. However, you can see that the biggest growth was in the share of unbanked households that have used prepaid cards. That proportion climbed from 12 to 18%. And prepaid card use is particularly high among households that had an account in the past, with more than 1 in 4 previously banked households using prepaid cards. Overall, more than 15% of all prepaid card users are unbanked, and another 1 in 3 are underbanked. And I want to point out here that this might be interesting data to help us learn more about the puzzling results in Drew's paper that so many unbanked payment recipients actually were receiving payments electronically. It might be interesting to see whether or how those results have changed with the 2011 data. And we know that direct express adoption has grown, and we can see here that the use of the general spending prepaid cards has also grown, particularly among the unbanked. So maybe somehow bringing this data into the analysis could be a way to look into whether a portion of the unbanked recipients were receiving funds to these general spending prepaid cards without actually having an FDIC-insured bank account. Moving on to the next slide, I'm just going to go through a few of the main policy implications that we've drawn from our survey results. First, we see a real need for policymakers to better understand the different segments of the unbanked and underbanked. They're not homogeneous populations. Even within specific banking status and demographic groups, there's a lot of variability between household financial behaviors. And we looked, for example, at unbanked Hispanics and found a real dichotomy. On the one hand, there's a substantial segment, about 30% of unbanked Hispanics, that don't use any AFS at all. On the other hand, though, we also found that unbanked Hispanics were among the most active AFS users, more likely to have used AFS recently or to have used multiple types of AFS. So it would be really difficult to try to put a one-size-fits-all strategy for this group. And Drew's paper actually is a good example of work focusing in on a specific subpopulation among the unbanked and thinking through policy questions specifically related to that subgroup. And we hope that focusing in on and understanding different segments like this can help to lead to more targeted solutions that can meet groups' financial needs or policy issues. On the next slide, the second implication confirms existing research that banking status is dynamic. Having a bank account at the moment doesn't guarantee long-term or full engagement in the financial mainstream. This is something that Drew mentioned, and as we know from our data, about half of the unbanked households in the U.S. were banked at some point, and about half of these previously banked households say they're likely to open an account again in the future. So there's a lot of transitioning in and out of bank accounts. We also know that about a quarter of our fully banked households have used AFS in the past. So at that time, they would probably have been considered underbanked. The point is that effective economic inclusion strategies require not only bringing households into the banking system, but also keeping them there. The third implication on the next slide is that being more fully engaged in the banking system does appear to have an association with positive perceptions of bank accounts and with less use of AFS. For example, remember that unbanked households that were previously banked were more likely to see value in having an account and were more likely to want to open an account in the future. And we also found that having an account, particularly a checking account, was associated with much less use of AFS. Our analysis found across several measures that unbanked households were the most active AFS users, especially of transaction services. And finally, the next slide shows the fourth implication, and that's that financial institutions can play a bigger role in demonstrating to households that there's value in having a bank account. We saw that AFS users feel that non-banks are more convenient, faster, or less expensive providers of transaction services and offer lower barriers to qualification for credit. I didn't really have a lot of time to get into all of that data today, but it is available in our report. So banks really need to confront these issues head on, knowing that convenience is the main reason why AFS users use non-bank transaction services. Banks could develop and demonstrate their own products convenience. For example, mobile banking technologies could prove very convenient and attractive to AFS users. Remote deposit capture could help make funds available quickly, which would be a potential competition to non-bank check cashers who are often perceived to be faster. And on the credit side, banks that work to make affordable small dollar loans available with streamlined and solid underwriting could help attract customers that currently rely on credit AFS. And wrapping up, the next slide shows a screenshot of economicinclusion.gov, which is a website that was created to showcase the household survey data and make it accessible. If you visit that website, you can sort of scroll around and highlight different states and MSAs, get specific results for the geographic levels that you're interested in, and you can also find national level results and charts there. If you want to get into the raw data, the complete data set will be released by Census in December, and you'll be able to access that directly from Census's website. We'll put a link here on economicinclusion.gov as well as on the FDIC website. That concludes my remarks. On my last slide, it's just have an email address there that you can use to contact me or the survey team if you have questions, comments, or other ideas about the data. And it really is our hope that a lot of researchers and policymakers out there will make use of this rich data set. Drew's work is one great example, and we hope that there are others interested in digging into the data as well. Thank you.
Great. Thank you, Susan. And next, I'm going to turn things over to Michael Morris, who's the Executive Director of the National Disability Institute. Michael?
Yes, thank you. appreciate having the opportunity to be a part of the panel today. I'm assuming, since I'm in a place where I can't see my slides, that my PowerPoint is available to those on the call?
Just need to let us know when you need us to advance the slides.
Okay, no problem. Okay. Well, first, I just wanted to share a little bit with you, for those of you who may not be familiar with National Disability Institute. I'm the founder of the organization. We started 10 years ago. And the mission of the organization, it was back then and still is today, is to build a better economic future for Americans with disability. Our focus has been to, in utilizing multiple strategies, working in partnership with government, with financial institutions, with the business community and community nonprofit, is to really increase people's understanding of the economic realities for people with disabilities and to build pathways to economic self-sufficiency that advance a better economic future across the full spectrum of disabilities, people with disabilities and their families. Next slide. Our methods have been, since we're based in Washington, D.C., we have worked on public policy reform, on attacking asset limits in terms of remaining eligibility on different public benefits, public education activities, public-private partnerships, and research. And it's really related to research that I wanted to share a piece of work that we did during the past 6 months. We began to receive quite a few emails and in our different trainings and interactions with the disability community across the country. We kept hearing about challenges with the mandated debit card, with the movement of people on Social Security benefits, SSI and or SSDI, and the eventual, as we move to next year, March 2013, that no one who would be receiving any further a paper check, and if they're not banked, would be expected to use a prepaid debit card called the Direct Express Debit MasterCard. And we sort of dug deeper in terms of our research, and if you go to the next slide, we eventually developed a report based on research on mandated debit cards, a bad deal for people with disabilities and other low-income Americans. Next slide. What we have learned is that there are many people living in different areas of the country, in high poverty rate areas, and the higher the poverty rate area will be the highest percentage of people on SSI or SSDI currently receiving paper check payment from the Social Security Administration. We also began to study the data in terms of where there are surcharge-free ATMs. And what we were able to find is that in numerous states that there are people with disabilities, others receiving Social Security benefits, who basically live in parts of the country where there is no surcharge-free ATMs available. We did some further deeper research targeting particularly two states, Iowa and West Virginia. And in West Virginia, we found that 58% of West Virginians with disabilities who do not live in a zip code with a surcharge-free ATM. We found some similar results, not as extreme, with people with disabilities in Iowa. We have, next slide, what we've learned is that there is a loss of benefits due to the surcharge fees at ATMs. We also learned about challenges in terms of customer service by Co-America, the bank under contract with Treasury and SSA to implement the program. And we have and continue to learn anecdotally about increased challenges with identity theft. We met with the Senate Help Committee to talk about what the options were in terms of public policy, in terms of changes in the way this program is evolving and going to roll out completely March of next year. We also met with the Consumer Financial Protection Bureau. We met as well with the Administration and Community Living at Health and Human Services, and we met as well with the Social Security Administration. Everywhere we went, people were empathetic to what we learned, but at this point, no changes have been made. And I guess in terms of the presentation today, I want to leave you with a number of questions if we go to the next slide. And the first is, by outsourcing really the government responsibility that exists and has existed in the making of public benefits payments, Social Security, and other public benefits, veterans benefits, SNAP, food assistance benefits, how much revenue is now being generated by, in our case, people with disabilities and other Social Security beneficiaries in making ATM transactions that is on top of whatever the contract is between Co-America and Treasury. Question number two is, what efforts are being made to help explain to the unbanked Social Security beneficiaries the upcoming March 2013 deadline and improve their understanding of how to use the prepaid debit card and improve their understanding of the benefits of being banked? Question number three, next slide. Should there be any cost to beneficiaries for the use of the card to access their benefits? And really, in some ways, this is the fundamental question. I'm not opposed, and as an organization, we're not opposed to the opportunity for a technology-based transaction which enables people to actually get their benefits potentially faster, use their benefits for the most basic needs as a basic social safety net. But should any part of that benefit be utilized to pay for the transaction which is now in place in terms of accessing the public benefit? Who bears the cost? What we were told by Treasury, what we were told by some of the other places we went to talk about this challenge is that, well, the government is saving tens of millions of dollars by moving to this system, that the ultimate answer is to move people off of unbanked status, and that, in fact, we're probably helping people who are unbanked by preventing them from using or reducing their need to use check cashing places where the fee structure is even higher. And yet, we still believe the fundamental question, which has to be taken on, is where is the balance of interest here? What consumer protections, what consumer education is ultimately an obligation of Treasury, is ultimately an obligation of the Social Security Administration, and other federal agencies that are now using this as the method of transaction between the ultimate beneficiary and the government agency. We have asked, and have not yet been told, is whether or not Co-America, who has a monopoly here, and although it was publicly competitively bid, one company was granted this right, is how much exactly is being collected by Co-America in monthly transaction fees? And how much are those transaction fees on top of what Co-America got as the basis of this contract to move to implement a debit card system? Next slide. What better consumer protections can be put in place that prevent the growing ID theft problem? It's our understanding now that the IG's office at Social Security has identified already over 19,000 cases of identity theft. And then finally, what can Treasury do to negotiate or eliminate ATM surcharge fees and other fees that are part of the structure of Co-America? There are fees to get a paper statement monthly upon request. There are fees for a transfer of funds to a personal account. There are fees for a card replacement. There are fees for rush delivery of the replacement card. And these are all on top of the fees related to ATM withdrawals in locations that are not surcharge-free. I bring all of this forward to you, I guess, on this call because fundamentally the most direct answer to these questions is the continued effort and push by multiple federal agencies, by multiple financial institutions, to find a way to move those who are unbanked to bank status. And second, the fundamental answer is for those who are not, and those who are going to be part of this type of debit card system, how do we offer the maximum consumer protection that protect against identity theft, protect against stolen resources, and ultimately, what kind of consumer education should be in place for individuals who are challenged in terms of going to an ATM and understanding what's going on, in terms of someone who calls them and says, I need information and I'm going to help protect you in terms of your card. There are so many ways that people who are vulnerable, and this is not just people with disabilities, but also seniors, need a better system than one that's been put in place. National Disability Institute, and I hope working with other organizations, working with Treasury, working with Social Security, I think there are better ways than what is currently in place. And I hope those of you who are interested in learning more about what we've learned and have ideas or strategies or comments on exactly how to create a better balance between the ultimate vulnerable consumer and Treasury and the agencies that are now offering their benefit on a debit card, we can create a better deal, we can create a fairer deal, and we can create one that's in the best interest of all parties. I think I'll stop there. You have my information on how to reach me at NDI, and certainly be willing to answer questions or listen to comments. Thank you.
Great. Thank you, Michael. You've given us a lot to think about. We do have a few questions that have come in already, and we'll start with this one that is for Drew. Can you explain in layman's terms what your study results mean for human services practitioners? So that's for those that work one-on-one with recipients of income supports.
Thanks for your question. Our research sort of takes a 30,000-foot view on the whole situation, and it's not our, we don't have a ton to say about individual choices about whether or not it's more cost-effective for people to choose different financial instruments. But that said, once you identify the population that definitely will have to make a big change for this policy, on a personal basis, people who receive check payments or new payees to the system after March 2011 will just need to set up a new way to do that. And that may be difficult, more or less difficult, depending on the financial wherewithal of that household. The two main alternatives I see are that they open a mainstream bank account or open a direct express card. However, there are some exemptions. There's a third choice for the people who are very elderly, geographically remote, or for certain kinds of disabilities. And it remains to be seen how many of those exemptions are taken up.
Great. Susan or Michael, did you want to weigh in on this question?
I think the answer is a pretty good one. I think that we are not putting in place for the human service professional really to be armed with the information to better share with the ultimate beneficiary or consumer. And I think there is more that needs to be done between all the parties here to offer a better environment, both in terms of learning and ultimately consumer protection.
Yeah, I echo Michael's sentiments there. I think it's a good opportunity to bring in financial education to talk about the benefits of banking and the consumer protections involved in the banking system. You know, this is a good moment for that transition.
Okay. And Susan, here's one where we'll start with you. So this participant submitted, interest rates in the past few years are so low, or banks' requirements for minimum balances, that having a savings account does not make financial sense. As long as interest rates stay low, the chances of opening a savings account or certain interest-bearing checking accounts will not improve, correct?
Well, I think at the FDIC, we definitely take the view that there are a lot of different types of benefits to being in the banking system. I mean, not just collecting interest. We think that having an FDIC-insured savings account or bank account, you know, you get the FDIC insurance, you get the consumer protections, and it makes it easier for people to build assets for people to save and accumulate wealth. It can make it easier for people to access credit on fair and affordable terms, and ultimately build credit histories, things like that. So it's not simply about, earning X percent of interest. I think it's about getting all of those benefits that come with being in the banking system. We do have one of our economic inclusion initiatives was a pilot on model safe accounts. We were working with banks to offer low-cost checking and savings accounts that would get rid of some of the hurdles of the high minimum balance requirements, and monthly fees, things like that. We actually have a model safe accounts template that we worked with the pilot banks, and we're sort of encouraging more widespread adoption of transaction and savings accounts that have, low minimum balances, low opening balances. We're talking about maybe $5 here for opening and minimum balances on safe accounts. So, working with the financial institutions like that to offer affordable products, I think could also be helpful.
Great. Drew, did you want to weigh in on that as well? No.
Yeah, I agree. There are many obviously benefits to having transaction accounts besides interest rates. It's tough to say whether to encourage any particular one household to open this product or that. It just depends on so many different things.
Great. All right. Well, with that, I'd like to thank Drew for his presentation and Susan and Michael for your discussant participation, and thanks to everyone who's been online today. Just a reminder that this presentation, including the slides, will be archived at cfs.wisc.edu within the next week to 10 days. And our next webinar is on Tuesday, November 13th. So you'll see an email invitation for that as well. Thanks and have a great day.